resident gets sideways on you, they can leave you with a $10,000 bill and you never see them again. Whereas if you're in a 300, 200 unit apartment building, not only do you have managers on site keeping an eye on things, but you've also got maintenance on payroll, and you've got a much more commoditized product to where even if somebody moves out and trashes the unit, a lot of times we're still turning those over for, I think, gosh, a really bad turnover might be $2,000.
Yeah. Right.
Maybe $2,500, right?
Yeah.
Or a house, they're into you for 10, and all of a sudden you've lost cash flow for the next 10 years.
Hello and welcome to Pillars of Wealth Creation, where we talk about creating financial success with a special focus on business and real estate. I'm your host, Todd Dexheimer. Now, let's get to it. Are you ready to start investing in real estate today but don't know where to start? Sometimes investing can seem way too complicated, but it actually couldn't be any easier than with homeinvest.com. You know the co-founder and my friend Nate Armstrong. He appeared on episode 20, and if you haven't heard it, go back and listen to it, episode number 20. Home Invest is a company that allows you to invest in turnkey real estate. Their goal is to build powerful investment tools that make real estate investing accessible to everyone. They have contractors and property managers available for you with the click of your mouse. While other real estate agents can only offer a property, Home Invest brings you a full turnkey package that allows you to diversify your investments, earn passive income, and start building equity in properties. Their simple, intuitive design allows newcomers and experienced investors alike to hit the ground running and to be able to choose the properties when they want and where they want. View easy to understand charts and data to allow you to buy in only a few clicks or just a simple phone call. With Home Invest, you'll be building your portfolio as quickly or as slowly as you would like. And right now, Home Invest is giving our listeners, Pillar of Wealth Creation listeners, a free course on how to finally win in real estate investing. So go to homeinvest.com/pillars. That's homeinvest.com/pillars to claim your free course today. Hey, welcome back, Pillars of Wealth Creation listeners. I am your host, Todd Dexheimer. With me today, I have Ivan Barratt. Ivan, how are you doing today?
Fantastic, Todd. Thanks for having me on the show.
Yeah, I appreciate you being on the show. A little bit about you. Ivan's a multifamily owner, manager, syndicator who specializes in FHA and agency financed assets. And we'll expand on that a little bit so our listeners know exactly what that means. But since 2015, he's raised nearly $30 million in equity, acquired over 2,000 units, and grown Barratt Asset Management, BAM, to the best-in-class management company. Today, Ivan focuses his time on equity finance, acquisitions, and company strategy. Currently, Barratt Asset Management manages well over $150 million in assets, comprising nearly of 3,000 units. So you're doing some third-party management and then a lot of your own property management as well, it looks like. With that said, can you give our listeners just a little bit more about your background? Maybe how did you get to that point?
Sure. Again, thanks for having me. It's great to be on the show and have a chat with you, Todd. I always enjoy running into you at different conferences and exchanging information. So, without boring anybody too much, I was pretty lucky. I had a dad that had some rental properties, an uncle that had some apartments, and another uncle that didn't graduate his second year of high school, let alone get all the way through, but became very successful in business. Yeah, very successful in business and in commercial real estate. So got a bug for entrepreneurship pretty early, and really because I wanted to be lazy, I thought, why not own a lot of real estate, watch the rent checks come in, and then just do whatever I want? Why get a real job? Of course, it turns out it is a real job, but was at least smart enough to know that I wanted to be in real estate. So in college, there was a real estate concentration through the business school of Indiana University. And so I picked the real estate concentration. So came out of there with a degree in real estate finance and a lot of student debt. Not necessarily something I would recommend everybody do. You can learn a lot listening to good content, reading great books, getting coaching, that kind of thing. You don't have to go to college by any means to learn what I learned there, but I got out with a pretty solid foundation and remembered something out of Rich Dad, Poor Dad, which my dad gave to me in 1996 when I graduated high school. And that was really the theory behind don't work to earn at that age, work to learn. And so I was able to get my foot in the door with a real estate developer and got to experience and work on several different facets of real estate development, asset management, property management, acquisitions, dispositions, putting deals together, and got a great education. And then also the biggest gift probably in my adult career would be the crash in 2008. I was definitely at that time a big hat, no cattle, wannabe young buck who thought he knew everything about real estate. And when everything fell off a cliff, I realized that I had chosen to disregard everything I learned in Rich Dad, Poor Dad about focusing on cash flow, and instead was focused on speculation, capital gains. And so everything came to a halt. I ended up being several $100,000 in debt. I'm trying to convince my wife, who's my girlfriend at the time, that I was a good bet and to marry me. And not look at my financial picture too much. And out of that turmoil and that trial, that's when I got really focused again on real estate. I'd always wanted to grow an apartment portfolio, and I basically decided that at that time my goal was 10,000 units. It's higher now, but I basically decided the journey to 10,000 units starts with that next deal, and stop trying to be too sophisticated, too sexy. Just get into a deal. I only owned one duplex at the time. And so from there, I found a way to get in to a couple duplexes in a very nice area, renting to kids that had just graduated college and were looking to go to the bars every night. I was able to get those seller financed at the time. And then I started looking at how to use hard money. And so my next several small multifamily projects, 2-3 unit deals, which is about all you can find in Indy. We are a sea of duplexes, an ocean of duplexes, and not a lot of 4 to 6 unit buildings. So I started using hard money to renovate small projects. I'd go find the ugliest piece of crap I could find, most distressed asset I could find in a good area in the path of redevelopment. What really started growing my cash flow, though, was I started BAM at the same time and did everything myself, basically managing other people's properties to bring in cash flow and to build this management machine that would grow, provide cash flow, and allow me a platform to use to continue to buy larger and larger assets. And for the longest time, we had more third-party management than we did owned assets. It's much easier to go out there and win management contracts than to find deals at times. So I was able to scale that very quickly, started hiring folks, and really grew the company, and then started buying bigger deals at the same time to where we are today. We are around 70 employees, about 150 million in assets under management. I've got some big contracts, some big projects under contract for Q4, and I get to have a lot more fun now. I used to do everything. I've done it all in real estate, as far as managing rehabs, managing tenants, toilets, clients, all that. Today, I get to focus a lot more on what I'm best at because I've got a really great team. And I've worked really hard to be the dumbest guy in the room when it comes to just about everything else besides strategy and raising equity for deals.
Awesome. I like the one thing that you said there. Well, a lot of things you said there, but one thing that you said there stuck out, and I wrote it down, and I kind of tweaked it a little bit. But the journey to your goal starts with the next, deal. So you talked about you want to get to that 10,000 units, but you said the journey to getting there is it starts with your next deal, which I think is great.
Yeah. So my dad, I grew up listening to Earl Nightingale and Zig Ziglar, and he had every tape course under the sun. And he would have these sayings, your rewards in life are in proportion to your contribution. That was one of his favorites, but also he would say, the journey of 10,000 miles starts with the first step, right? Or he'd say, by the mile, it's a trial. By the inch, it's a cinch. And as a kid, I'm like, Dad, you're really freaking weird. But as you get older, you realize this guy's got, some actual words of wisdom here. And one day it just dawned on me, and I just, instead of miles, I put in units. And that's when I said, stop trying to go from 0 to 50 units and just go out there and buy another duplex, man. Just get going. Take action.
Yep. No, I couldn't agree more. Yeah. When you're a kid, you're like, Dad, I just want to play with my Transformers. I don't care what weird stuff is coming out of your mouth.
That's right.
So you chose property management, which I hear is a very hard business to make money in. Why did you choose property management?
First of all, you are correct. Property management, you've probably heard me say this on stage, but I can always spot a rookie in this business when they tell me in property management they don't want to be nickel and dimed, because property management is a game of pennies. I wish it was a game of nickels and dimes. There's not a lot of profit in it, and I'm just going to say it sucks. It is extremely hard. But I saw an opportunity in the fact that nobody really wants to do it, and I could create some good economies at the time. Very few property managers had an online portal. Very few property managers had a business degree. So I figured if I could figure out some technology to make it more efficient, if I could apply some of that business education and be a little more sophisticated than your average do-it-all property manager who might just be like a glorified handy guy with his wife doing the books, I figured I could create value. And again, nobody wanted to do it, and it was a way to get reoccurring cash flow. So I wasn't as focused on like squeezing out a huge amount of profit. It was more, how do I build this scalable machine that will allow me to build a track record, build a platform, have a team of employees that can help execute the business plan. At the time, I read a book, I can't remember the author's name, but it was the guy that founded Kinko's, which eventually became FedEx stores. And it's a great biography about how he built that business. But one of the key tenets in it, now you don't even need to read the book. The key tenet was, anyone can do it better than me. And so he would scale the business, and little bad things would happen. They'd make tons of mistakes. It would take longer to get it up and running, but he figured out this way to get other people to buy in and to learn and to make those mistakes and fail forward. And then all of a sudden, he's got this scalable company with lots of people in it that are empowered to do their job. And I thought, wow, for a generally lazy guy like me, that sounds like a really good way to go. And so it was really hard to bite my tongue a lot, but I started figuring out more and more how to not micromanage people, how to let them learn by me letting little bad things happen and not trying to control everything. I think I've gotten off on a tangent from your topic there, or your question, but yeah, the main thing was I knew most people didn't want to do it, and I needed a recurring fee model, and buying real estate one deal at a time, it didn't have enough cash flow in the beginning to support building out a team of folks that could do a better job than me. And that track record helped me get my first few investors.
So were you managing duplexes or when you started managing third party, or were you managing bigger properties?
No, single family duplexes. I basically would take anything I could get my hands on where I didn't have to carry a gun. Rental collections is one of the toughest parts, but if you stick to, in the beginning, to B and A assets where you've got residents that have good credit and care about that credit, you've got this big stick if they start getting behind in the rent. And so it made the collections part of it a lot easier. In 2009, 10, 11, 12, it was really tough to sell condos in my market. So I would get all these condos that people couldn't sell. So they were sort of landlords by accident or by force.
Yep.
Single family homes in the suburbs that were underwater, and lots of duplexes from investors. Didn't really start managing apartments until later on, after we had a platform of 1 to 4 family deals that we could get our hands on and manage.
Sure. Yeah. So to talk about a penny business, single families are probably much worse than the apartments where you've got some scale, I'd imagine, right?
Well, you get higher fees in single family, but the problem is they're all over the place. Every owner's got a different opinion on how it should be run. You get much better economies on apartments, even though the fees per door are less. It's much more scalable. Single family, you really can't scale that model, but I had to use that to leapfrog into bigger and better things. And we did a good job of it for a while. And then we got to a point where we just couldn't afford really to manage that type of asset anymore because of the time it took. And so we started letting clients find other management companies along the way.
So there's a question for somebody who's looking at, I've got maybe 5 single families, or maybe I want to buy 20 of them or whatever it is. But I want a third party to manage them.
Yeah.
When that person is looking at a third party management company, should they be looking at a management company that has 500 properties that they manage, or should they be looking at a management company that has maybe 20?
I think 20 would very likely be way too small. And 500 is probably going to be too big unless they've got some really good systems. My question for that 500 unit manager is, how many clients do you have? Right? Because if I've got one client that owns 500 properties, that actually you can scale.
Sure.
You can set policies in place that make that client happy. You can have certain rules that you're following on cost of turnover. You've got a lot of decision-making flexibility, right? If they've got 500 clients that each own one unit, then that's a problem. That's a problem. That is extremely hard to manage and very time consuming. You're not going to get a lot of attention. You're not going to get a lot of personal communication. It's just impossible, really.
Okay, good, cool. Well, it's nice to hear it from somebody who's been in it and knows like where are the stressing points, because as you're looking and you go, because I think it's easy to say to when somebody's looking for something like that. And I know I've dealt with it because I've got some duplexes that are out of state, and you look at these companies that are really big and you go, oh, they're going to be great, right? Because they've got 500 or 800 units that they manage, but you find that they can't pay attention to your property or properties. So I've had a lot more success with the companies that have more, maybe not 20 units, but more like 100 units around there that they manage. Yeah. It seems to be maybe a little easier for them to manage the properties. And you mentioned you kind of have given up some of your smaller clients. Is that right? Oh yeah. Lots of small clients. We've parted ways for sure. It's just we can't manage it anymore. And a lot of times we were taking on clients that had got into a turnkey situation.
and then realize it's a bad situation. And so they fire the turnkey management company and hire us. But the problem is their model's already off to a bad start. They didn't properly underwrite turnover costs, which is one of the biggest things I see in all up and down asset sizes. Investors.
Let's actually talk.
Yeah.
Let's talk about what are some key things that maybe you see mistakes that owners are making, and what can they do when they're looking at these properties to make sure they're avoiding those mistakes and actually being successful.
Yeah, well, I'm sure a lot of your audience already knows this, but what I see a lot of people failing to do is that they've got maintenance correct, maintenance and repairs. They've got vacancy probably correct, but what they're failing to properly underwrite is the cost to turn over those tenants. If you've got a duplex and it's in a really cool area and you're renting to young people, maybe you don't have to paint as much because the demand is still there. It doesn't have to be perfect every time, right? But when you get into multi-unit buildings, in many cases, when the resident moves out, you've got to completely paint every square inch of that place and recarpet it. And the kicker is in a lot of cases, you cannot charge much, if at all, to the tenant moving out. If they've lived there a few years, you can't really bang them too hard for worn out carpet. You can't bang them for worn out walls. So that cost is on you, the owner, to make that rent ready again. And then the incoming residents expect that. They expect a fresh coat of paint. They expect clean carpet or new carpet. And if you can't do that and you're cutting corners, then you're also probably attracting the wrong kind of tenant, the wrong kind of resident. So I see that up and down the asset chain where people are failing to recognize the cost of turnover, which behind property taxes can be your biggest cost.
Yeah, I couldn't agree more. I mean, that's a big expense. It's hard on a single family or duplex level, and I'm sure you've bought plenty of them and you've managed plenty of them. It's just hard to. It's so easy to get it wrong, I guess, because it can get expensive. I mean, and you're losing a lot of money when you have one unit vacant. You've got a big turnover, and then they don't cash flow anyway.
Yeah, and you really hit the nail on the head. With a big house, one unit, one roof. Especially if you're buying C+, B- properties, resident gets sideways on you, they can leave you with a $10,000 bill and you never see them again. Whereas if you're in a 300, 200 unit apartment building, not only do you have managers on site keeping an eye on things, but you've also got maintenance on payroll, and you've got a much more commoditized product to where even if somebody moves out and trashes the unit, a lot of times we're still turning those over for, I think, gosh, a really bad turnover might be $2,000.
Yeah. Right.
Maybe $2,500, right?
Yeah.
Or a house, they're in you for 10, and all of a sudden you've lost cash flow for the next 10 years. Right. And then you're like, well, the guy that sold me this told me they'd be on a beach right now, sipping tropical drinks. It's really why I got out of the single family management game, and also my small multifamilies. You get a little bit more economies of scale, but the real fun gets going when you get into the bigger stuff, as you know.
Yeah. Well, I'm laughing because I've been there completely. Like the $10,000 thing. That's a real.
Oh yeah.
For those who are listening and you don't have any single family, you're going to go out and buy one. It's fine, but do understand that $10,000 deal that happens. I've had that. Well, and you're dealing with maybe a 2,500 square foot house, so there's just a lot more.
Again, great point, Todd. Even if they treated it well, but they lived there for 3 years, you've still got to carpet the place, and you can't charge them, and you've got to paint every square inch of a 2,500 square foot home. The turnover costs get so high.
Yep.
And again, you go back, the investor says, well, that's not on my model. I can't pay for that. And that's a tough situation for everybody when that happens.
Yeah. Hey, I want to interrupt this episode real quick to talk to you about Nate Armstrong, our sponsor, Nate Armstrong. He's with homeinvest.com, and you want to get to know Nate. So go to homeinvest.com and just connect with Nate, talk to him, learn about his operation, what he's got going on. He's a turnkey provider, and it may not be right for you, but it could be the perfect fit. So it doesn't hurt. It's a free call, consultation, just to figure out, what they do, what they have to offer. And worst case is you're going to meet a great person who's really well educated in real estate. He's done a ton of different real estate strategies, and probably he's going to teach you a little bit, even on a short conversation with him. So go to homeinvest.com and connect with Nate's company. You're definitely not going to be disappointed. It's worth it. So thanks, and we'll get back to our show. Well, let's talk about going bigger and scaling.
Yeah.
And so we've already kind of talked about why a little bit, but let's talk about just that process of going from those duplexes to now you're buying 100 plus unit buildings, 200 plus unit buildings. Let's talk about that and the difference. And how did you get started? What made you start?
So yeah, today I've got under contract a 314 unit deal, which will be my biggest one yet. Just by a few units. I've got a 302 unit project we bought earlier this year, a 240 unit project we've got. But back up before that, my first big apartment deal was 6 units. Then I bought a 35 and a 30. And then I said I'd never do a small deal again, and I bought 15 because it was just too good to pass up. Then I jumped to a 60 unit project, and then the next project after that was 112 units, and that's where I got on-site staff, a little bit better financing, and once I got up to the point where I could afford on-site employees, there was no looking back. It's a game changer. It's highly addictive. You don't want to do it any other way when you get up there. But you've got to find a path to get there first. So whatever you want to talk about, we can talk about the big stuff now. We can talk about those mid-sized deals, whatever can deliver some value to the audience.
Well, I think, okay, let's just talk about it this way. You did this kind of step up model. You started with these little, these duplexes, and then you got up to whatever you said, a 6 unit, then a 30 unit, and eventually you got up to the 112, and you said, holy cow, like I need to be doing only that and bigger.
Yeah.
Let's talk about somebody starting out. What advice would you give them? Would you say, let's go, just do the same route, or maybe is there a different route that you think is maybe even more effective, or what's your opinion on that?
So one of my mentors, who's never met me, actually I did finally get to meet him a couple of years ago, but I loved his saying in his book, and it was start at whatever level you can start at that you're comfortable with. The key is to just get going and take action. So for me, I was comfortable with buying a few more duplexes in some smaller apartments. Today, if I had to do it all over again, I would start with the big ones. But I think the most important advice I can give somebody is just get started. I look at it like getting started at the gym with a new fitness plan. You're not going to go in there one weekend and lift your ass off and have a 6-pack and be able to run 3 miles with your son in the morning like you do, Todd. It's the exercise and the diet you do every day. It's these little things that stack up, and when they stack up, they create value. So it's underwriting a deal a day, having a goal that I'm going to go to coffee with an industry professional and a potential investor once a week, right? It's that momentum that you can build on. So I can't hit that home enough. If you are comfortable getting a 12 unit deal done, do a 12 unit deal. If you want to aim higher and you've got some investors you can get with and a plan, aim higher.
Yeah, I couldn't agree with that more too. And one of the things that I always tell people is to just don't get stuck. Like you don't need to graduate. You don't need to take too long to graduate. Like if you feel like you have to start with that, you know, duplex like you did, then the 6 unit, then the
Yeah.
30 unit, and then well, you went backwards, but then then back up to the 60 unit, and then eventually the 100. That's fine. Do that, but make sure you're making that step progression. If you eventually want to be buying 200 unit buildings, you've got to somehow get there, and you can't just stay at the single family level forever. I did that for 8 years. I stuck buying those things, and like I thought I had to graduate somehow. And I even had like
Yeah.
people telling me, "Well, you know, eventually you'll get there, and you know, but you got to start where you're at." And it's like looking back, it's like, no, you don't. You don't have to stay there forever.
No, there's no amount of houses you have to get first before you can buy apartments. It's a whole different ball game. So yeah, jump right in with a 4 unit. I would say if you're going to go north of 4, as you know, and you get into that commercial level, if you can, it would be better to get up into a deal where you've got at least $1 million of debt. Get a couple friends together, some existing relationships that you can raise money through, and go after something where, as you know, that $1 million debt mark, you can start looking at agency debt, get better terms on the debt, better amortization, better cash flow, and less interest rate risk.
Yep. And I think you would agree by already hearing you say it is the sooner you can get to that 100 unit building, probably the better, because that's a turning point. I did the same thing.
Yeah.
When I got to the 100 unit level, it was like, whoa, I'm not going to go back and do a small deal, because it's just a big turning point for scale. I think is just having that on-site presence at the property is huge.
Yeah. And then we get to the point where it doesn't make sense unless, you know, we're at 150 or 200, and we just keep going up from there.
Yeah. Cool. Let's talk about operating your business successfully. You've got a successful property management company. You've got your successful acquisition and syndication company. Let's talk about that. What are some key, maybe 2 or 3 key ingredients to operating the business successfully that you've had for there?
Yeah. You know, for me, it's got a lot to do with people. People is figuring out how to manage and lead people sometimes can be harder than real estate. It can make the real estate seem easy. But you know, it's a necessary skill. So what's really helped me, you know, I'm not the sharpest tool in the shed. I am, you know, lazy by nature. I'd rather be hanging out with my kids, watching TV, or hiking or biking or anything, right? Than tennis and toilets. But learning how to deal with people, being persistent in that, you know, refusing to give up, and persevering through the inevitable failures. And another saying that my dad loved to say was that mistakes are stepping stones. And the more stepping stones that you can find, the farther you're going to get. You know, it's that fail forward, fail a lot, figure it out as you go sort of mentality, and emphasizing what works well, cutting out what doesn't work well, and just constantly tinkering on the management machine, working to give people good technology, being really curious about how things work and how they might work better. I think all those things, again, go back to that mentality of taking action, of trying to move forward. I think a lot of people get stuck on the starting line. Oh, I've got to have a business card, and I've got to have a website, and I've got to rent an office, or right, I've got to have all these things that I've built up in my mind to keep me from starting. When what I really need to do is just start. Just do something today that moves it, even if it's an inch, one step forward. and then trying to do that same thing the next day, move one step forward again. And those steps really start to add up over time. I think you and I can both agree, a year goes by really, really quickly. And all of a sudden, you're either a year ahead and you're like, wow, I can do 300 push-ups, or I can run 5 miles. And a year ago, I couldn't do that. And it seems like only yesterday that I couldn't do that. Or what happens to a lot of us, myself included, I wish I had started sooner. A year goes by and you're like, wow, I haven't done squat. I am still sitting here.
Yeah. Man, I made that decision a year ago and I was going to do that. No, we're still at this starting point.
Yeah, exactly.
So you talked about persistence, being persistent through making mistakes, and making mistakes are stepping stones. And what's some mistakes that you've made? Let's do one mistake, not all of them, because I'm sure there's more.
Well, we'd have to do several podcast episodes to get through just the first. Yeah.
Let's just go through one mistake and how did you learn? The most important part is, how did you learn from it? What'd you take from it?
Yeah. Let me think here for a second. The first and foremost, I'm the kind of guy that I hit every bump in the road, every mistake. I fall, trip, bruise my legs over everything. But I never will hit the same bump twice. I won't trip over the same stone twice. And if you can go ahead with that mentality, knowing that, hey, I don't know everything I need to know. Failure is a part of the ingredient, is an ingredient to success. And you just keep moving and not try to predict all these mistakes ahead of time, and just realize that we all make mistakes. It's part of the learning process.
Yeah.
That's what I call paying tuition. You're going to be a lot better equipped and have a lot better chance to succeed. Probably the biggest mistake or personality flaw that really hurt me in the beginning of growing the multifamily side of the business, if I'm being really transparent, would be arrogance. I had been successfully renovating smaller, 2, 3, 6 unit deals, and thought I was hot shit. And so I, jumped into some bigger deals, didn't do as much underwriting as I should have, thought I could raise rents more than really the market was going to allow me to do, and thought that managing 35 units was like managing 15 duplexes. It's not. There's a lot more expenses that I didn't account for, little things like extermination, more wear and tear on the units, a ton more tenant issues or resident issues between units, not having the right manager in place. I know you said one mistake, but all those little things, I thought I could arrogantly just overwork or outwork them, And so if I could go back in time, I would have underwritten those deals differently. I would have approached them differently. The good news is with apartments, guys, is that you can make those mistakes, and if you buy it right, you can still eke out a really good return. So that 35 unit deal was me and one investor. We sold that late 2017 for a 9% IRR. So you might think, wow, that really stinks. However, everything that could have gone wrong with that deal went wrong. Brand new boilers ended up being really cheaply misinstalled, and really cheap equipment had to be replaced. More resident evictions than we thought possible. A snowstorm collapsed carports, just all kinds of crazy stuff. Way more sewer leaks than we ever could have imagined. And we were still able to get a 9% return, and that investor is still with me today and continues to invest. And so I hope that would encourage people out there to not feel like they have to know everything before getting started. Maybe the biggest lesson would be, don't think that you can make improvements from cash flow. finance the improvement dollars up front with equity and or debt if you can, and it makes sense. And if the deal doesn't make sense with having those funds available day one, it's probably not a deal.
Was there anything you did to keep that investor? And you made 9%, that's whatever. Was that just, were they just okay? Like, hey, that's 9%, let's do it again? Or was there something maybe you did during that whole time where it was just crap? Because I'm assuming this thing probably didn't cash flow very well at all, if any.
No, it didn't. I mean, we didn't get much cash flow out of it for a while. The biggest thing was being transparent, owning my mistakes, not dreading calling the investor, not waiting for them to call me, calling them, telling them what's going on, telling them where we're at, telling them, hey, this is the plan from here. This is what we're going to try to do to get more cash flow out of this thing. This is, the new manager we hired. This is the other thing we're trying, right? And just really keeping a high level of communication and transparency, and being proactive about, hey, this isn't the market's fault. This isn't my manager's fault. This is my fault. This is ultimately my responsibility, and I'm going to work my butt off to make it right. And we're either going to succeed or you're going to find me, dead alongside the road. And that mentality has kept him with me, and we've since gone and done better deals. I would also say the lesson there that I didn't have to learn the hard way. Not all money is the same, right? Just because an investor says they want to invest with you doesn't make them a great investor. Really, especially in the beginning, I would keep an eye out for people that understand a little bit about real estate, like real estate. Maybe they're entrepreneurial. Maybe they've got some other investments, right? If this had been that investor's only, say, 150 grand, and he didn't have a portfolio and some other liquidity, if that had been his life savings, right, and that he was betting on my dream apartment deal, it would have turned out a lot differently. It would have been a lot more stressful and difficult. But because I had an investor that rolled with the punches, understood that these things can happen, it ended up working out to be a decent deal, mediocre at best. And we've gone on to do more.
But a deal that actually went pretty smoothly. Well, the deal didn't go smoothly, but when you look at the overall picture, what happened throughout the thing, that was actually pretty good, because there was a couple of key things that it sounds like you did. You communicated very well, and you worked your butt off to try to make sure you at least made a couple bucks. But then beyond that, as you had the right partner in place for that type of deal, you just didn't take any Joe Schmo that had a couple bucks sitting around and take their money to use. Which when you do that, you got to be very, obviously that's a totally different situation. So some great points there. So great for the listeners. So we're getting a little long, which is great because you've gotten a ton of good advice already. So I'm going to ask just a couple more questions before we wrap up. First question.
Sure.
Is, what's your favorite book that you've been reading either recently or maybe you're reading right now or just finished within the last year?
A couple of books. I'm a huge fan of sales training, and I think one of the best sales trainers on the planet right now is Grant Cardone. I love his material. His YouTube's a little crazy, but if you want to syndicate real estate, he's definitely somebody to listen to how he approaches it. But his pure sales training is some of my favorite material. He wrote a book that's not actually that popular. It was written during the Great Recession called If You're Not First, You're Last. It's not the story of Ricky Bobby. It's actually a sales training book for just how to get out there and hustle. It's a very tactical book. And I just finished reading it, I think for my 5th or 6th time. On the economic side, there's a book that's recent publication called Collusion by Nomi, Prins. It's a book about what the central banks around the world are doing with currency manipulation and money printing and quantitative easing and tightening, and how they're working together. It's a really academic book, but there's a lot of good information in there on the dynamics of money and why I think it's important to understand that stuff. If you're going to be out there buying income property, understanding the global currency situation.
Awesome. I've not read either of them, so I'll have to check both those out. I have read a couple of Grant Cardone's books, and for the most part, they've been pretty decent. Last question. What are your 3 pillars of wealth creation?
3 pillars of wealth creation. Business, being the management company, for sure. Second pillar would be the acquisition, syndication of real estate. That's the wealth bucket. The business is the cash flow as well. Keeps the lights on, keeps food on the table. And then I would say really the third thing is going to be liquidity. If you're going to be in this game a long time, you need to have a good amount of liquidity for unforeseen issues, but also as you get into the big leagues, liquidity becomes a key factor in getting the best financing. I'd throw insurance in there too. I know you only asked me for 3 pillars of wealth, but good insurance is definitely a pillar. Risk management.
I like that. We got a bonus.
Yeah.
Cool. So I guess the very last question is, how can our listeners get in touch with you, learn more about, your syndication business, just to talk to you, know what you're doing and what you're up to? How can they reach you?
Absolutely. So my phone number to my assistant who manages my calendar is 317-762-2625, 317-762-2625. I'm very easy to find on the internet. My last name, Barratt. You can Google me and find Barratt Asset Management, ivanbarratt.com, and I just dropped a new website, ivanbarratteducation.com, which is a video series for high net worth investors that want to get more educated on what guys like you and me, Todd, are doing, how we look at the world, how we underwrite, what makes us good sponsors versus the rest of the herd out there.
Awesome. Well, that's great. So anybody listening to that wants that information, whether they want to learn or whether they want to learn about what you're doing, I think that's fantastic. So we'll put that all in the show notes. Appreciate it. Well,
great to be here, man. I really enjoy the conversation.
Yeah, absolutely. I've had fun. You've brought a ton of great content, so our listeners can get a lot out of this. I appreciate that, and we'll chat soon.
Anytime, Todd. Thanks for having me.
All right, that was great. Special thanks to Ivan Barratt for joining us on the show. Appreciate all his value, man. He's just crushing it out there, so it's fun to see as well. A couple things I took from this episode, along with many others, but a few things. First of all, is persistence. He talks about mistakes are stepping stones. Make sure you're, able to make those mistakes, take those stepping stones, just continue to push along and be persistent with that. Next thing he talks about is work to learn, not to earn. So as you're working, make sure you're doing things that are helping you learn. With that, then will come the money, will come the opportunity, will come the business growth. But make sure that you're doing things to learn and not just to earn. It's not all about the dollar. It's easy for that to sometimes be our focus. We need to make sure we're focused on, what's important. And that is, definitely learning, definitely growing, definitely, self-development, all that kind of stuff. So the next thing he says is start with the level you're comfortable with. And I think that's really important. We get this message of, think big. You think of that Grant Cardone, the Donald Trump when he was cool. And we think of, think big. That's awesome. But that's the sexy thing to say is think big. That sells. If I'm going to tell you to think big, you become a millionaire in just a few, just a short year or maybe even less. Well, then hey, that's awesome. I'm going to pay for your course. I'm going to, follow you. And that's great. I do agree with those people. You do need to think big. Sometimes thinking big is great, but make sure you start smaller if that's what it takes. Just start. And I think that is kind of the message that he says. Start with what you're comfortable with, and maybe just a little bit outside of your comfort zone for sure, but start with, maybe more or less what you're comfortable with, a little bit, push your boundaries a little bit, but don't worry about thinking massive. If thinking massive means you buy, a big shopping mall, but you just never can get started because it's too daunting or it's too big or there's too many hurdles along the way. Well, it'd be better to start with a 5-unit building or a 20-unit building or whatever you can. So awesome information from Ivan, so much more. So make sure you go back and re-listen and take notes. For everybody listening, appreciate you joining us. Appreciate you being a part of the show. Go on to iTunes if you haven't already. Subscribe to the show. Give us a rating and review. 5 stars, of course, would be appreciated, but give us a rating and review. And then go on to Facebook and join our Facebook page and give us some comments. Let us know what you like about the show. If there's anything we need to do to improve and provide you with more value, let us know that as well. And then also, give us some questions. What's on your mind? What do you want us to answer? What do you want us to talk about? Is there anything in particular you go, hey, I wish they would really focus more on this, or I have a question on this particular aspect. So if there's any of that, Facebook is a great place to connect with us, and we can have a conversation there and then on this show for sure. So get connected, get onto iTunes, give us a rating. That would be fantastic. And then, let's keep on learning. I'm Todd Dexarmer. I'm signing out. Make every day a Saturday. Are you ready to start investing in real estate today, but don't know where to start? Sometimes investing can seem way too complicated, but it actually couldn't be any easier than with homeinvest.com. You know the co-founder and my friend Nate Armstrong. He appeared on episode 20, and if you haven't heard it, go back and listen to it, episode number 20. Home Invest is a company that allows you to invest in turnkey real estate. Their goal is to build powerful investment tools that make real estate investing accessible to everyone. They have contractors and property managers available for you with the click of your mouse. While other real estate agents can only offer a property, Home Invest brings you a full turnkey package that allows you to diversify your investments, earn passive income, and start building equity in properties. Their simple, intuitive design allows newcomers and experienced investors alike to hit the ground running and to be able to choose the properties when they want and where they want. View easy to understand charts and data to allow you to buy in only a few clicks or just a simple phone call. With Home Invest, you'll be building your portfolio as quickly or as slowly as you would like. And right now, Home Invest is giving our listeners, Pillar of Wealth Creation listeners, a free course on how to finally win in real estate investing. So go to homeinvest.com/pillars. That's homeinvest.com/pillars to claim your free course today.